Welcome back to Investing Doc Podcast.
Today we're looking at AST SpaceMobile. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. AST SpaceMobile, or ASTS. This one is, well, it's maybe the ultimate high-risk, high-reward space stock out there right now.
High risk, high reward definitely sounds right.
Yeah. Fundamentally, you have to understand it's still a pre-commercialization company, so it's value. It's almost entirely based on future potential, future execution, not really on today's revenue.
And that potential, I mean, it's potentially enormous, right? We're talking disruption. Their main selling point, the whole bull case really, hinges on this technological moat they have.
Uh-huh.
What exactly is so revolutionary about their tech? How is it different from, the other satellite players?
It really comes down to one key thing: direct-to-phone connection. So unlike Starlink or others where you need a special dish or some kind of specific user hardware, ASTS is building tech that lets your standard smartphone, like the one you have now, 4G or 5G, connect directly to their satellites.
No extra hardware needed.
Exactly. And that's crucial. It gets around this massive hurdle of having to build and sell consumer hardware, which is, a huge cost and logistical challenge for their rivals.
So they're basically trying to blanket the Earth in coverage, using satellites as giant cell towers, hitting places normal networks can't reach. Sounds amazing, but is it actually proven commercially viable?
Well, that's where the recent news becomes so important, that validation piece, the partnership they announced with Verizon.
Right, the Verizon deal.
Yeah, launching direct-to-cell service starting in 2026. That's critical. It's not just some small pilot test. It's a major U.S. mobile network operator, an MNO, saying, yes, we think this works and we want in.
Why is partnering with an MNO like Verizon so much better than just trying to sell this service directly to people?
Oh, it totally de-risks the whole go-to-market strategy.
Yeah.
Think about it. Verizon, they already have the customers, millions of them. They handle the billing, the customer service, the regulations.
They have the whole infrastructure already set up.
Precisely. So ASTS doesn't need to burn billions trying to acquire customers or build a whole new sales channel. They just become the wholesaler, the network provider behind the scenes. It gives them instant access to this huge U.S. customer base via a trusted brand.
So it really shifts the focus onto pure execution then. Can they actually get the satellites up there and make them work reliably?
That's exactly it. And the market seems to believe they can, judging by the stock chart anyway. The momentum has been just explosive.
Explosive is the word. Year to date, 2025, ASTS is up, 249%?
Yep, 249%. And that's building on over 1,000% gains in the last 3 years.
Yeah.
Technically speaking, the price is still sitting comfortably above its 50-day and 200-day moving averages. That generally signals a pretty strong long-term bullish trend.
Incredible run-up. But okay, let's bring it back down to earth a little. How much of that huge rally is based on real progress versus, maybe just hype and speculation? FOMO.
That is the million-dollar question, isn't it? Or maybe the billion-dollar question here, especially when you start digging into the actual financials.
Right. The tech might be futuristic, but the P&L statement is very much present-day reality for a startup.
Exactly. And this is where we need to lay out the bearish case. Despite all the buzz, the revenue is still tiny. Like first half of 2025, total revenue was just $0.75 million.
$750,000. That's barely anything.
It's basically nothing for a company with this valuation. It's mostly from small testing contracts, not actual commercial service fees.
And while that revenue is just a trickle, the spending, that's a different story. Building a global satellite network has got to be one of the most expensive things you can possibly do.
Oh, absolutely. The operating losses are still running incredibly high. They lost $94.6 million net in just the second quarter of 2025.
Wow. Almost $100 million in 3 months.
Yeah. And for the first half of the year, total expenses burned through $137.6 million. They are just consuming cash at a rapid pace to fund the CapEx, the capital spending needed to build and launch these complex satellites.
That kind of burn rate immediately brings up the funding question, right? How does a company making less than $1 million cover costs exceeding $100 million every 6 months?
And that leads us directly to the recent turbulence in the stock price. To pay for that massive CapEx, especially for the upcoming big satellite deployment, the Bluebird constellation, ASTS just announced a huge $1.0 billion financing round in October.
$1 billion through convertible senior notes.
Correct.
Okay, let's pause there. Because that sounds good, getting $1 billion in cash. But what exactly are convertible notes, and why did the stock tank right after they announced it?
That's a really key point. See, when a company sells normal stock equity, they sell shares now. Convertible notes are different. It's essentially debt today.
Okay, debt.
That has the option to be converted into equity, meaning new shares, later on. Usually that conversion happens if the stock hits a certain price target or when the notes mature.
So it's debt, but it comes with this looming threat of future dilution. More shares hitting the market later.
Exactly. That's the trade-off. The $1 billion definitely shores up their cash position, gives them a runway well into 2026, which they absolutely need to execute their plan. That's the positive.
That's the negative.
The negative is it introduces this very real risk of substantial future share dilution. When those notes eventually convert, the number of shares outstanding could jump significantly, watering down the ownership stake of everyone holding shares now. Plus, it adds more debt to their balance sheet. So the market reacted instantly because that dilution risk suddenly became very concrete and very large.
That makes sense. So if the management team is confident they can execute and needs this cash, what are the insiders doing with their own shares? Does their activity signal confidence?
Well, insider activity can be a telling sign, and lately the signals here are leaning negative. Looking back over the last 6 months, there haven't been any reported insider buys.
Zero buys. Okay.
But there has been quite a bit of selling. The chief technology officer sold over 111,000 shares, netting around $3.87 million. We also saw notable sales from the COO, the president, and the CFO.
Management selling millions worth of stock right after securing $1 billion they say is critical for executing the strategy.
It doesn't exactly scream confidence, does it? It kind of suggests they know how risky the execution phase still is.
It definitely sends a cautious signal to the market, yes. And it probably contributes to why the general analyst consensus right now is more cautious, leaning towards reduce or hold. They see that execution risk combined with the dilution overhang as significant headwinds.
Okay, speaking of that market reaction to the dilution risk, the stock fell pretty hard, didn't it? From nearly $90 down into the $70 range right after the announcement. Where are the key technical levels traders are watching now? Right, it was a sharp pullback. The key support zone everyone's watching now seems to be around $70 to $73. That's kind of the line in the sand for the bulls.
$70 to $73 support. And resistance.
Resistance is back up near those recent highs, say $85 to $90. So the near-term trading range we're kind of looking at is maybe $70 on the low end, up to maybe $95 on the high end if bullish momentum returns.
And what are the momentum indicators saying? Did they just collapse?
Interestingly, no, not entirely. Indicators like the RSI and MACD, they pulled back, sure, but they still seem to be holding a generally bullish bias. It suggests this might be more of a consolidation phase, a shakeout after the financing news, rather than a complete breakdown of the uptrend, at least for now.
Okay, so technically, still some signs of life, but fundamentally huge risks remain. This conflict really shows up in the analyst price targets too, right? They seem to be all over the map.
They really are. It perfectly illustrates the uncertainty here. You've got B. Riley Securities clearly buying into the big growth story with a very bullish $95 price target.
$95.
Okay. But then you look at Barclays, and they're much more conservative, down at $60. And if you average it out, the median analyst target is actually even lower, somewhere in the $45 to $54 range.
Wow, $95 down to $45. That massive spread really tells the story, doesn't it?
Yeah.
It feels like a binary bet. Either they nail the execution on launching these satellites, or the cash burn and dilution just overwhelm the stock before they can scale up.
That's precisely the tension. Projecting future earnings is incredibly speculative right now because any significant commercial revenue depends entirely on them successfully deploying this huge Bluebird satellite constellation. And that's still a ways off.
Right. That main deployment is targeted for 2026 and beyond.
Yeah.
So in the meantime, what are the key things investors should be watching for in the shorter term, like the next few months?
The most immediate thing is their Q3 2025 earnings report. That should be out around mid-November. People will be looking closely not just at the financials, the cash burn rate, but really for updates on operational progress.
Progress on the satellite deployment timeline.
Exactly. Any updates on hitting that target of 45 to 60 satellites deployed by 2026? Any hint of delays or maybe even acceleration will be a major market mover.
And you can't ignore the retail sentiment around this stock either. It's a huge favorite on places like X, on investor forums, partly because of that high short interest too, right? It's around 25%.
Yeah, that high short interest definitely adds fuel to the fire. It creates potential for squeezes. And there's tons of speculation swirling around, unconfirmed rumors, mind you, about maybe landing another big global carrier partnership like the Verizon one, or maybe securing some lucrative government contracts before year-end.
And if any of those rumors turn out to be true?
With 25% short interest, yeah, you could see a very sharp, very fast move back up towards those $90 highs. It's a volatile mix.
So looking beyond all the near-term noise, assuming they navigate the funding and start launching satellites, what's the ultimate long-term prize investors are hoping for here?
Look, if, and it's still a significant if, but if they can successfully manage the immense operational and financial challenges over the next, say, 18 months, the big payoff is the full commercial launch of that Bluebird constellation. That's slated for the 2026-2027 timeframe.
That's when the real revenue starts flowing.
That's the idea. That's the moment the switch is supposed to flip, unlocking large-scale service revenue and potentially starting to justify the kind of massive valuation the market is assigning to it today, even with minimal current income. So wrapping it all up for someone looking at ASTS right now, what's the verdict? The underlying investment case, it really leans bullish if you believe in the technology and their ability to execute. They have a clear tech lead, and now they've secured that huge chunk of funding.
But it's a massive if.
It's a massive if. It really is a binary outcome, isn't it? If they execute flawlessly on the satellite launches, on the commercial deals like Verizon, the potential upside is truly enormous. But if they stumble, if the cash burn gets out of control, if there are technical setbacks, launch delays, then the dilution risk and the operational failures could mean the downside is just as significant. It really is a bet on astronomical growth versus very real, very difficult operational hurdles. A moonshot, basically.